This is the Nichols Patrick Current Federal Tax Developments for the week of October the 31st, 2016. Current Federal Tax Developments are brought to you by Nichols Patrick CPA Incorporated and your state society of CPAs. This week, we're going to talk about a number of interesting things in this week as we get to the Halloween edition of Current Federal Tax Developments. We're going to find a former tax court judge ended up getting the trick this past week, entering a guilty plea to conspiracy to deceive the government. We have an IRS ends up with inflation-adjusted numbers for 2017 that they issue this week. We end up with a discussion of the taxation of love offerings for a minister who told his church he didn't want to take a salary, but he would accept love offerings. We talk about the meaning of the word including becomes a key issue for a tax court case we're looking at this week. Social Security also gave us more index numbers for 2017. And the Affordable Care Act relief that the IRS, the Department of Labor, and Health and Human Services gave to colleges that was supposed to end for plan years beginning January 1st, 17, has now been extended indefinitely. So we'll talk about that. Well, we're in the middle, as you should know by this point, of CPE time. And I'm getting ready to do some sessions down in Tucson. On November the 10th, I'll do the 4-hour Arizona Ethics and 4-hour Arizona Tax Law. And on November the 11th, I'll do the full-day current federal tax developments discussion, where we'll discuss the various updates that have taken place over the past year. Now, this will be down at the Viscount Suites in Tucson. If you're in Tucson, or you can come down to the Tucson area, you can go ahead and sign up at the Arizona Society of CPAs website. I'll be there again on the 10th and the 11th this year, coming down there to do those sessions. So I look forward to seeing you all down there in Tucson. Well, let's start with our cases for this week. And the first case really isn't a case per se, but it is a court issue. And this is the case of a former United States tax court judge pled guilty to conspiring to defraud the IRS of $450,000 in taxes. That was per a Department of Justice press release that was issued on October the 21st. Now, former tax court judge Diane Krupa was the individual involved in this particular case. And the issue involved, to a large extent, though not entirely, the activities for her former husband's business that was reported on the tax return, but there are also some issues that were related to herself. The problem became that, while she was there as a judge, the IRS ended up having concerns about her tax returns. And they took a look and brought her returns under examination. Well, the issue kind of got nasty, to put it mildly, and it turned out that the IRS felt there were a lot of highly questionable deductions. Now, as you might have guessed, a tax court judge is the sort of thing that the Department of Justice would love to issue press releases on. So turns out that Judge Krupa, who left the tax court, resigned from the tax court a while back, which was apparently, we can't say for sure, but it seems by its timing be related to this issue, the examination. She resigned prior to her indictment. We ended up with this particular case where the IRS was looking at some of the issues that she had claimed. Now, what they did, they put together, according to the press release, they put various questionable expenses on the return, including rent and utilities for their Maryland home as part of the consulting service of her husband. They took utilities, upkeep and renovation expenses of their home in Minnesota, pilots classes, spa and massage fees, jewelry and personal clothing, wine club fees, Chinese language tutoring, music lessons, personal computers, expenses for vacations to Alaska, Australia, the Bahamas, China, England, Greece, Hawaii, Mexico, and Thailand. And according to the press release, through 2004 through 2010, they fraudulently deducted at least $500,000 of personal expenses on Schedule C. As well, the press release goes on to state that basically made other false claims, is what they take, including failing to report approximately $44,520 that the judge received from a 2010 land sale in South Dakota. And also the agreement goes on to claim, or the press release goes on to claim, that she falsely claimed to be insolvent to avoid paying taxes on $33,000 of cancellation of debt income. What happens at this point is Judge Krupa pled guilty to one charge. There was a number of charges in the indictment. She pled guilty to a single charge, and effectively, the press release was issued. Her husband had previously pled guilty, so this is just a secondary of the plea agreements. But as I say, not so much a development you're going to work with in your practice, but it is something that probably is of interest because many of us have read the decisions of Judge Krupa over the years. As you may recall, we haven't read them in a while. This is obviously part of the reason why they hadn't been read. Let's go ahead, though, and talk about the inflation indexing that we have for this week. The IRS this week in Revenue Procedure 2016-55, issued on October the 25th, issued a bunch of inflation-adjusted numbers for 2017. Congress, as you may be aware, fell in love many years ago with the concept of inflation indexing, and we have most, but not all things indexed. And Congress last year decided to index a bunch of penalties as well, along with when they extended Section 179, they indexed that as well. So what we have now are the new information. Now, the full details are in the revenue procedure and in the downloaded PDF you can get from our website at currentfederaltaxdevelopments.com for this week's program. But what we'll have is we have all of the basically the tax tables for the year. That is the tax rate schedules. So you can take a look at that. We have issues, for all the things like the personal exemption, issues under an income credit. We have other items that come in here for refundable credit under qualified health plan, all kinds of neat little things. Now, some of the big things you'll probably be interested in. The Section 179 number is going to go up next year to $510,000. We'd love for it to be $710,000, but $510,000, and it will begin to phase out at $2,030,000. In this year, 2016, it didn't get an inflation bump, so it was $500,000. We did get a minor inflation bump on the phase out to $20,010,000. Well, now we're up to $20,030,000 for next year. Also, the estate and gift tax issues change. Lifetime transfers, as we basically already knew a while back, are going to go next year to $5,490,000, up from this year's $5,450,000. The annual gifting number of 14,000 is not going to change. Another thing that finally changed was the maximum cafeteria plan deferral. As you may remember, as part of the Affordable Care Act, ended up being restricted to $2,500. Finally, we have enough inflation to bump that up. So for 2017, the maximum that can be allowed as medical flexible spending account deferrals into a cafeteria plan will be $2,600. As I said, all of the other phase-in amounts that we have here, which basically this particular document covers everything except the qualified plan and IRA numbers. We will cover those next week. But basically, so almost everything else is inflation adjusted will be found in here. Again, you can download it from our website, or you can go ahead and download. We also have on the website the link to the full revenue procedure 2016-55. Next up, a case for basically a minister, the case of Jackson versus Commissioner. This is Tax Court Summary Opinion 2016-69. It was issued on October the 24th of 2016. Now, Mr. Jackson was the pastor, a director, and the registered agent for the Triumph Church of God. He was also a church director. The church had 25 to 30 active members, and as many as 7 ministers, and offered services 3 days each week. You might guess that's quite a bit of work for ministers for a church of 25 to 30 members, and it might be a little difficult to pay salaries in that scenario. Well, Mr. Jackson effectively agreed to go to work for the church. He'd perform services as a minister. In fact, he essentially had signature authority over the bank account. But he said he didn't need a salary, but he would accept love offerings from the congregation in lieu of being paid a salary. Now, Mr. Jackson took the position that the love offerings were non-taxable gifts to himself. And so the court had to take a look at the question of whether or not these were gifts or were they taxable compensation. Now, the court noted from the Duberstein case that distinguishing the two, this is an old Supreme Court decision, distinguishing a gift from a non-gift is in many cases very, very difficult. But it decided in this case that it could make the call. As the court noted, Mr. Jackson very openly at trial said that he informed the board of directors that he would accept love offerings and gifts as substitutes for salary. Well, of course, if they're substitutes for salary, then they're being paid to him for purposes of the services he received. An actual non-taxable gift is a transfer basically of somebody with no expectation of receiving anything in return, and not meant to compensate that person for having done something. It's just a, generosity alone is what causes you to make the gift. In this case, it's a little more like we talked about, we've talked about those issues of crowdfunding or situations where people put money up to get people to develop a product, and sometimes without even getting a right to get the product. This is a little bit closer to that. You're putting money in, and the theory being that hopefully if enough people put money in, Mr. Jackson will continue to serve as a minister. Now, a couple of other things that went against Mr. Jackson. The bookkeeper of the church issued him a 1099 miscellaneous. Now, Mr. Jackson claimed, after it was pointed out to him that this had happened, that he went back and they were supposed to have amended the 1099, but that 1099 was never amended. In fact, the bookkeeper left the church, and Mr. Jackson's daughter took over as the bookkeeper for the church. But regardless, nobody ended up doing a revised 1099 miscellaneous. So the tax court found that in this case, those funds received by Mr. Jackson were truly compensation for services, and compensation for services, as always, is taxable to the taxpayer that receives it. The meaning of specific words can be a major problem in tax court in the Internal Revenue Code. And the tax court case of Partita Partners LLC versus United States, I should say not tax court, but this is U.S. District Court from the Southern District of New York, case number 1:15-CV-02561. The opinion came down on October the 25th of 2016. Now, one key issue here, the word including. We're going to deal here with an issue in Code Section 170 H4B. And it deals with restrictions if you give a qualified conservation easement of property in a certified historic district. In such a case, you generally give an easement to protect the exterior of the building so people going through the historic district see the buildings as they were to begin with. The idea is it preserves the look and feel of the area. And you can grant that partial interest in the real estate to assure that that outside will not be changed. That was what would happen in this case. Now, if you do that and do it properly, you can get a current income tax deduction for the value of that easement. But to do so, IRC Section 170H4B provides that the gift has to include a restriction that preserves the entire exterior of the building. Now, that clause goes on immediately following and parenthetically says, including the front, sides, rear, and height of the building. IRC Section 7701C, by the way, 7701 are the general definitions that we find throughout the code, tells us that including, when used in the code, shall not be deemed to exclude other things otherwise within the meaning of the term defined. Well, unfortunately, the taxpayers in this case didn't apparently realize that that was not an exclusive list. They granted the deed of easements, but the deed of easements allowed them to do additional construction conditioned on the approval. Basically, they reserved the right to add a couple of floors, 2 or 3 floors on the roof, and to potentially extend the ground floor of the structure. The IRS said, wait, that's not preserving the entire exterior of the building. Rather, that's going to be a major change to the exterior of the building. But the taxpayer said, no, we're not touching any of the specific items that were in that list. And so long as we don't touch those, it's okay for us to grant this easement. That's the definition of what the partial interest would be. The tax court, unfortunately, said we have that provision in the code, which means that we look at the plain meaning of the term shall preserve the entire exterior. Entire means everything, not just that list of items. And so because they reserve the right to make exterior modifications, the tax court found they had not made a qualified conservation easement contribution, and that meant that effectively a deduction of over $4 million was entirely disallowed to the partnership that had attempted to claim that deduction on the tax return. Well, again, it's indexing time of the year, as we said. We had the big IRS indexing. The Social Security Administration has also been involved in indexing. A news release they issued on October the 19th tells us what the maximum Social Security wage base will be for 2016. That maximum, after staying flat for a little while here, is going to rise next year by a fairly decent amount to $127,200 from the current year's $118,500. Also, the retirement earnings test, that's for those who take their Social Security before their normal retirement date. Remember, you can take it beginning at 62, but we have a discounted amount, and you're not allowed, if you take it at that point, you're also not allowed to, earn more than certain amounts. That general reduction number for 2017 will be $16,920, except for the year in which the taxpayer reaches full retirement age. In that year, the number will rise to $44,880. We also have a change in what's defined as a quarter of coverage. A quarter of coverage, which we know is not really a quarter, is $1,300. So for every $1,300 you earn in the year, that's FICA wages or self-employment income, you're granted a quarter of coverage. You can earn a maximum of 4 quarters. So that means that effectively, when we get to $5,200, we have all of the credits we could get for the year. And you can earn all of that $5,200 totally in the first quarter of the year. So that's why quarter is a bit of a misnomer for a term, but it's a term the law uses. That again moves to $1,300 for 2017. Social Security also released on their website on the 19th the domestic worker threshold amounts. The domestic worker threshold amounts for 2017 are going to be unchanged from 2016. That threshold amount will remain at $20,000 this year. So we'll have the same basic number as we had last year for determining when we have to deal with domestic workers and the Social Security payment amounts. Finally, we have the IRS issuing additional relief to educational institutions. In Notice 2016-17, on February the issue, or that was issued on February the 5th, 2016, through the IRS, Department of Labor and Health and Human Services, had issued relief that would allow schools, many universities, have students that work for the university. And many of those, especially for graduate students, et cetera, they offer to those individuals a discounted access to student health insurance. Now, this health insurance was most often run as an individual policy. The problem becomes under the Affordable Care Act, as we all should be aware from a couple of years back, you can't really have the school paying for individual policies or subsidizing those. In essence, it begins to look like that is a payment of individual premiums. Remember, you cannot do that, or because that's going to be deemed to violate the Affordable Care Act's market reform provisions. And when you violate those, the penalty is $100 per day per affected individual. Well, the problem turned out, as many universities said, that they have done it this way for years. As I said, back in February, the IRS decided, well, we'll give you to the beginning of next year to change yourself over to a compliant system. The colleges and universities apparently are still, we're still going to be telling them, no, this is complicated. We have long-term agreements with people. We have been doing it this way for years. It's not going to be simple for us to convert over to some system where we provide employer-provided health insurance coverage instead of the student coverage. So what has happened now is on October the 21st, the IRS announced that this particular rule about extending and granting relief for plan years beginning before January 1st, 2017 will now be extended permanently, or not permanently, but indefinitely. So until there is further guidance issued, we are not, the universities will not have to worry about having to change their programs to allow the students to get some sort of employer-provided coverage or take away coverage entirely. As we always know, it's always interesting whenever the agencies issue one of these, well, the relief is open until we tell you something different. Now, sometimes that really is a short-term run, and within a few months we get the new rules. But it's also been used as a place to park things that never change. Think about the requirement to electronically file to report on healthcare costs for your employees. And we have had this temporary exclusion for those who file less than 250 W-2s. That temporary exclusion is going on now. It was been out for years that we've had that particular rule, since 2012. And it's going to be in place now for sure all the way through 2017. You begin to wonder when you see things like that, if this relief is just going to we're just going to ignore the law and we're going to go ahead and let people continue to violate it without penalty. Because that's effectively what you're saying, because the law requires that on the W-2. it is very possible this could become another one of those provisions where we just never actually get down to the IRS and Department of Labor actually clarifying this. So you'll need to keep your eye on this. If this is going to become real, I suspect it would move sometime next year. If it's not, though it drags out for 2 or 3 years, then you begin to wonder if they're ever going to enforce this provision. Unfortunately, they can't really say we're never going to enforce it because, effectively that would be them overriding Congress, which technically they're not supposed to do. But it does mean that you got to keep your eye open, and I certainly would. I would suspect you may not need to rush to get your plans converted, at least unless we get some more signs they're doing something. Well, it's Halloween. At least it is the day that I'm going to release this on Monday, the day where, the publication date of this, which is Monday. It'll be Halloween. So the trick and treat times is out. You want to be sure to go out there and look at your state society's CPE offerings. Says, okay, a little bit corny to look at, but we got candy corn on the screen. That they will be giving you the treats via the coursework that you can get over the next couple of months. Coursework that will allow you to interact live with individuals who are experts in the field. Be sure to come out and take a look at the catalogs. Be sure to sign up for those live courses, and including the ones that we do here at Nichols Patrick, including the ones that are done by other organizations sponsored by your state societies. So be sure to take a look, get signed up, and get yourself set for the coming tax season. This has been the current federal tax developments for the week of October the 31st, a Halloween edition. You can catch our daily updates online at currentfederaltaxdevelopments.com. Well, they may not be completely daily because I'm going to be on the road this week. I'll be out in Twin Falls, Idaho to start the week. Then I'll be at the Pacific Tax Conference for the Washington Society on Thursday, and then back for the Arizona Federal Tax Institute on Friday. I'll do 2 sessions there, so I'm going to be traveling around and then heading out to Boise and Tucson the following week. So, but I'll try to get stuff posted in the interim to get stuff up. Also, you can follow me on Twitter at Ed Zollers, which is just at Ed Zollers. Questions can be sent to me to edzollers@currentfederaltaxdevelopments.com. And be sure to join us back here next week when we'll have another update of the developments on the area of federal taxes.